Today it looks like we're going to get down to talking about an issue that we highlighted last January, January 24th and 25th. There's two videos, and then we followed up on April 18th of last year on the same issue. They're already pinned to the top of the TikTok. On X, I will try to put them underneath this video, okay? But it'll take time. Give me a chance. What's going on here? All right. So, as we know from prior videos, in the great financial crisis, 2007-8, the SIFIs, significantly important financial institution, didn't play in the treasury market. They didn't start playing until around 2013 when the basis trade came in, right? Now, SIFIs are about 20.4% of the treasuries. They were zero 15 years ago, okay? Now, the Fed was worried about this. So the Fed said, listen, our G-SIBs, our big bank, our globally significant, important banks, they have to have capital. And our G-SIBs have to have 5%, which we up from 3% for all the other banks, all right? So G-SIBs are at 5, all the other banks are at 3 because they're significantly important to us, right? They'll blow up the world. Now, so the Fed wanted the SIFIs to have the same capital requirements as the G-SIBs. And they put out a paper, this is how it's done, everyone discusses it. The SIFIs are totally against this, incredibly against this. They are screaming mad, right? Yet, they're 20% of our market. Now, at the exact same time, the G-SIBs, our banks, okay, said, listen, they sent a letter, literally, to the OCC, the Federal Reserve, and the FDIC. And they said, listen, we are not going to participate in the Treasury auctions anymore unless you get rid of the capital requirements for us. So think of where the Treasury is. The Treasury is trying to get the SIFIs to have the same capital requirements as our G-SIBs when they're bidding for treasuries, okay? And so the SIFIs are like, no way, but the G-SIBs are like, we're not even gonna participate anymore because we're not gonna have any capital requirements into the future, okay? So I have 3 videos all going. It has all the documentation, it has the letters in there. You can read it if you want because guess what? This is coming to fruition right now. But let's understand what may be happening or may not be happening. Now this is from our last video where this is from I think the Tokyo Times, okay? The Japan lawmakers warned tariffs threaten security, not just economic ties. And we saw this the other day. They said, we have to think about the linkage in this problem. The economy, national security, food security, economic security are now all linked. We know this. The Trump administration is putting all this in. It's not about trade. We're using trade as a hammer to get them to agree to what we want to do. But this is causing dislocations in the market, as we know, and we've talked about this a lot, especially in the last video, is that the big asset managers are now starting to reallocate away from America because of the perceived risk of treasuries and what the Trump administration is going to do. Expropriation and taxing of the treasuries. Now, why is this a problem? Why now? Well, look at us now. So here we have our interest complex, and all the interests are up. So that means the bond prices are down. And by the way, this is yesterday. So when we hit these rates the last time was that Tuesday morning when they did the 90-day pause on the tariffs because the bond market was broken. Now, the bond market is not broken today, but we must realize where we are. We are moving up in our interest rate complex right across the board, all right? And yesterday, we had our first look. So here's all where the money in the world is invested. And you can look up there, that's over 70% into America. And last year, we said many times, 74% of every dollar, yen, renminbi, anything in the world was invested in America. And I'm only going to point out to you that it's starting to turn, all right? Now, on the bottom, I think, is the European They have been moving there, and we also did, as you know, the other day, they're moving to Japan. But for the first time, we're seeing this happen. And here's the question. This is yesterday. Our stock market recovered all of its losses that incurred from Liberation Day, and yet our bonds have not. So, you're up to you. Are they selling our bonds because of our threats of expropriation and taxation on the treasuries that you hold away from the United States? So let's just gather ourselves and think about what we're talking about here. We had Liberation Day. The stock market goes down. We have now recovered that all back, okay? The bond market went down that day. We covered that, but now we're back up above where we were that day. So in other words, we're not seeing selling pressure on the equities in the United States. We're seeing pressure on our treasuries in the United States. And you have to decide for yourself, the whole world is this because of our threat of expropriation and taxation on the treasuries? Okay, so we already talked about the G-SIBs and the SIFIs. Now this is what hit today, okay? And what they're saying here is the U.S. is poised to dial back bank rules imposed in the wake of the 2008 crisis. Now they're gonna cut the bank capital requirements, and it's all about bidding for the treasuries. So all explained in those 3 videos. Marking the latest sign of deregulation agenda of the Trump administration. This is what I would question, right? Is it deregulation, or are we trying to create liquidity in the market to buy our treasuries given what we're facing? This is what you have to determine, all right? And they say here that they're looking to get rid of or reduce the SLR, the supplemental leverage ratio, from 3 to 5%. And bank lobbyists have been campaigning against the rules for years, saying it punishes lenders for holding even low-risk assets such as treasuries and hinders their ability to facilitate trading in the $29 trillion government debt market, and it weakens their ability to extend credit. What are they saying there? They're saying if we have to put up capital to buy these treasuries, to put them on our balance sheet, then we can't lend that out to somebody else. So the top half is about how treasuries are low risk, but the critics point out that given the recent market volatility and policy upheaval under the administration of Donald Trump, they're like, this doesn't sound like the right time to relax capital standards at all, says Nicholas Vernon, senior fellow at the Peterson Institute for International Economics. And as you can see here, Scott Bessent is totally on board with this, and even Fed Chair Powell said in February, we need to work on treasury market structure, and part of that answer can be, and I think it will be, reducing the calibration of the SLR. So there's 2 ways that they're looking at this. We don't know which way they're going to choose. One is the foreign banks have 3.5% to 4.25%, and we're 5%, as you know, so they want it reduced down to the foreign banks level. Or, in the last paragraph, they're saying that would exclude low-risk assets such as treasury and central bank deposits from the leverage ratio calculation at all. It would free up, they say, $2 trillion, all right? Like we're not leveraged enough now. But you can read the rest of the article here. You can see that the Fed, OCC, and FDIC declined to comment. Morgan Stanley thinks that really the only one it really affects is State Street, who is constrained by the SLR. So last year, the Federal Reserve was terrified that the SIFIs, or hedge funds, would not be able to pay for their treasuries if something went wrong during an auction, right? Which, as we saw, just literally happened, okay? And they wanted them to have capital requirements to know that they could pay for the treasuries that they're taking down, right? And the G-SIBs at the same time are arguing, we want it all off. And so in the end, it looks like under the guise of deregulation, which I think, and I'm asking you, what do you think? Is this so that we can buy more treasuries, or is it because we don't think it's fair?